Hi, everyone. It's PJ Patterson for a market update. Today's the 21st of May. It's Friday. Happy Friday. Hope you have rather a good weekend ahead of you. Weather's cooling down, so those of us here in Sydney and I dare say even further south, for those of you that might be watching this from Melbourne or somewhere further south, it's going to be chilly. So probably be sitting around the fire a little bit this weekend. Anyway, top three things today are going to be Quad 2, just a quick refresh of Quad 2 and where we're at, because you would think with what's going on in the U.S. right now that people are panicking and are positioning rather for maybe Quad 3 or Quad 4. Item number two is rates and interest rates. They are on the rise. They continue to rise. And I'm going to talk about that briefly. And then volatility. We've had a little bit of an episodic and non-trending spike in vol, but vol continues to retain its bearish trend, but we are getting some great opportunities to trade in and out of various things. So we'll cover off a little bit about volatility. So first and foremost, Quad 2. So I just want to refresh a couple of things that I've been talking about with Quad 2. The U.S. market is not the global markets. And so first of all, the U.S. market is not really positioning yet for what is going to be epic GDP numbers coming out in the next couple of months when they get reported. I mean, just look at this current forecast for GDP. Now, there's a couple of numbers all sort of bunched up here, but the reality is that GDP forecasts have been rising. I think the last time I might have shown this chart, the number was somewhere around 10% GDP for that quarter, and so it's now being revised up. The market isn't pricing this in fully yet. The market's still panicking over these stupid things like Bitcoin's crashing or some other ridiculous story that's floating around out there. And a lot of the panic is emanating from the hedge fund community that just isn't positioned right. But in any case, not going to go into all of that stuff. We've still got this in front of us. And then, of course, after we get that number, it is going to slow down and we're going to get a rate of change that's lower. But look at these numbers. I mean, they're still up in the 6s and 7s. This is US GDP, that is. It's still just phenomenal sort of numbers. So we're entering, again, this period there in the middle of this year where we're going to continue to see the Quad 2 conditions. We're in them right now. We're going to continue to see them unfold. We're seeing that playing out in the commodities complex, in interest rates, and in energy, etc. So again, I am not deviating at all from the current call, which is Quad 2 in Q2, and once we get through Q2, we'll the quarter two rather, we'll take it from there. So that's just a bit of an update on Quad 2. Again, the market's movements are not really suggesting that anything has changed. So once the market figures it out in full, I think we're going to see some epic bull market. Well, the bull market is in play here, but we're going to see some further bull market gains. And as Paul Tudor Jones has famously said, the last part of the bull market is typically the most aggressive, and it's also one of the hardest parts of the market to capture, because a lot of people right now are panicking and they're thinking, interest rates are going to break down, gold spiking, or some other ridiculous narrative that they've got. But the reality is none of those things are happening. They're episodic and non-trending, and I'll probably show you some stuff on that. Let's quickly talk about rates. So again, here's a chart of the 10-year yield and also rates. I think, European rates I've got here as well. These are all on the rise. Germany had a much more negative yield, and I think one other country, I want to say, well, Switzerland has a negative yield, but I think one other country did have a negative yield, which has now turned positive. Might have been the Netherlands, probably was actually. But their yields are now creeping up and looking like they're going to be going positive. Now, this is very interesting development because the bond market is pretty much saying globally, in the U.S. quite clearly, and then globally now, that we're anticipating inflation. That's why bond yields typically rise, is because they're saying, hey, inflation's starting to show up. We have to readjust our the rate that we charge people for our bonds or whatever to compensate for this inflation. Pardon me. And that's exactly what's happening. Gold, however, but gold seems to be thinking that when we see rates fall in the U.S., that this is a sign that maybe it's safe to get back into into gold, or gold investors rather, think it's safe to get back into gold. But look at this. I mean, we're just hitting a series of lower highs here, and that's exactly what this is going to end up being over the course of the next couple of weeks. You should very well see gold come off. We definitely don't want to be owning gold here. And again, gold is an inverse function of interest rates. As interest rates fall, gold will typically rise, and as interest rates rise, gold will fall. Gold is not like rising interest rates. So interest rates in the U.S. anyway have been falling a little bit here, and that's why we've seen this spike in gold. But again, that's very likely to reverse in short order, probably early next week, and start to head down. You can see it's sort of the sideways action in the Treasury yield. It's had a big run up, obviously, and it's kind of gone just sideways for a little while. We're seeing a lot of consolidations in a lot of markets, and that's really what that sideways pattern is telling us, is that there's consolidations happening in a number of markets. So anyway, that's a little bit on interest rates, and again, why I'm not worried about any of these movements in rates right now, because again, I think we're going to continue to see rates rising over the course of the next couple of months. Now, finally, just to talk about volatility, we have, one other thing I wanted to say about Quad 2 is global trade has had this massive spike in trade volume. And clearly the globe is responding to all of this epic stimulus. We've talked about this before. It's responded to that. Global trade is increasing. There's a whole number of metrics. I'm not going to go into all the charts and graphs. I had a mid-quarter update from Hedgeye on, I think it was Tuesday. It was on Monday their time, Tuesday. I watched that. And look, again, that's why I'm saying to you, all the signs of Quad 2 being in full effect are still there. And yet the market has not quite yet accepted that that's where we are. And that's evident by some of this positioning, where we continue to see, despite the S&P 500 hitting new all-time highs, we still see the market is positioned on the short side. Just phenomenal that that's actually the case. Big time short in the Russell 2000 as well. These are the small cap companies. Got a Russell position on at the moment in all of your accounts. So it's faded a little bit in the last couple of weeks, but I expect that the fact that the consensus position is short and we're in Quad 2 tells me that we're positioned absolutely perfectly to capitalize on watching this short position run off and turn into probably a long position. Anyway, we'll see what happens, of course. But just touching on volatility, vol has been bouncing around quite a bit. And again, we're seeing these episodic spikes in vol. The trend, however, is still low. Now, again, why is volatility important? So you've heard me talk about this, and I'm just going to grab the vol and drag it over into our view here. So this is a chart of vol. Why is vol important? Well, everything has volatility, first of all. And when volatility goes into certain ranges, we have to pay attention to that. Now, just to quickly refresh, the bull vol trend is sort of 9 to, and this is on the S&P 500, by the way, 9 to 19, in that range. So if volatility, or the VIX index, is in that range, bull market. Really, as vol falls closer to 9, really strong bull market. Vol between 20 and 30, or 20 and 29, is a trader's market. It just means that the market is bouncing between, it's moving up to highs and it's coming down to lows, and that's an inverse of the vol. So if vol went to, say, 29, you'd see a sell-off in things. When vol comes back to 20, again, you see markets moving higher. So I know I talk a lot about volatility, but it's one of the key metrics that you have to pay attention to, because it drives a lot of other things in markets. So this is one of the reasons why I constantly remind you of where we are with volatility. And as you can see on the screen here, all of these things in this middle column here are all volatility measures, but of different indexes and different things. And all the ranges mean different things as well. So even though, you see, say, here on oil, that oil volatility is at 39, the same range doesn't apply. So anything above 30 in oil is not an automatic sort of get out of the market and stay away from it. Vol has a different set of metrics. So anyway, I just wanted to reiterate that vol is one of those things where if you see a big sell-off in the market, check and see where the vol is. Has the vol spiked? So as you can see here, over the last week or maybe 8 trading days here, 8 or 9 trading days, you've seen vol kind of spike and then fall back down. spike a little bit, then fall back down. And this is, again, on a broader downtrend. So vol is trending down. It's in a bearish trend. So every time we have these little spikes, the vol just sort of, the vol spike just, it fades faster, or it fades fast, and it continues to move down. So again, just reinforcing for you that we're in quad two. We're in a perfect setup, perfect environment for inflation to continue higher because, again, the market is telling us that is going to be happening. The bond market is front-running inflation. Commodities are front-running that as well. Their prices continue to rise. And eventually, we're going to see the stock market catching up to that as well, which, again, is why I'm really not changing anything that I'm doing right now as far as positioning. You will have noticed this week that I have sold off a couple of things. Begun to scale back a little bit. So India is a great example of that. Whilst India is doing really well economically, of course, they're dealing with this COVID thing right now, and they're just not one of the things we want to necessarily own a lot of. So I do have profit in that position, and I'm just selling that down just to capture some of that in case things get worse there. Can always buy it back later. There's no problem at all in global macro with taking profits, and then if something shows that it's going to stabilize and move higher or whatever, and buying it back. There's absolutely no problem with that. And that's what a go anywhere strategy and a full cycle investor will do. I've sold off a couple of other small positions as well with companies that have done very well, reported some earnings, had a pop in their share price. Children's Place is one of those. I think that there might be a very, very small position left in that, but I've got a sell order in to capitalize on this move in that stock. And so I'm just raising a little bit of cash because I want to start to really take advantage. If we're still in this trader bucket of volatility, I want to take advantage of, some of the opportunities that will present themselves. So look, that is about it today. That's a pretty short update, but I think that probably encapsulates exactly where we are in the markets and what I'm expecting to continue to occur over the course of the next few weeks. I am still expecting there to be a very nice ramp in the energy complex, but the other sort of four horsemen in terms of the following, the XLI, which is the industrials, XLF, which is the financials, the materials, which is XLB, and of course XLE, which I've already just touched on, which is energy. Those are sort of right now the four horses that are running at the front of the pack. We own those. We own companies that are forming that are in part in those indexes. So XLE would be the heaviest weighting there, or the energy sector would be the heaviest weighting there. So again, not really making any changes or any moves, sitting tight, waiting for the payday. So anyway. If you have any questions about any of that, please do let me know. Obviously, just as a reminder, we're getting closer now to year end. So hopefully a lady has sent out to you the email regarding your super contributions for this year. Great time to get the more cash into your super account. And if you haven't received that, or you need a refresh or whatever, just please email lady on that one. You can send an email to team@keystonefinancial.com.au. That'll ping a few of my team members so they can address whatever concerns you might have. And for those of you who, where'd the bubble go? For those of you, there I am. For those of you who are hearing me talking about interest rates and might be thinking, well, now might be a great time to fix my mortgage or something like that, and you want to have a chat to me about that, happy to do that as well. I do think that the RBA is going to continue to manage and control the short end of the yield curve, which means 1, 2, and 3 year rates should, largely, in large part, continue to stay roughly where they are. And look, I don't know for sure, but I suspect in 6 to 12 months, if inflation starts to run a little bit, we're going to, not we, but the RBA here in Australia and the Federal Reserve in the US, and maybe some of the other central banks around the world, are going to have to start thinking about keeping inflation under control. However, one of the key things that's happening, one of the key things that is happening in the U.S. right now is a lot of the programs that were put in place to support workers during the COVID period who'd either been laid off or furloughed or whatever are beginning to be stopped. So a lot of the states now that were providing unemployment insurances and things like that are saying, that's enough. We're not continuing to support people not working. You have to get back into the workforce and get jobs. And apparently the labor market is very tight over there because a lot of the folks are basically getting paid to stay at home, which is just ridiculous. Now, whether or not that's happening here in Australia is another matter, but I suspect there's a little bit of that going on here as well, because, of course, we had very similar programs to support our workforce and to support people who either got laid off their jobs or whatever. So the reason I mention that is because as people return to work and jobs get filled and more jobs are opened up or whatever, it means more people are going to have more spending power. They're going to be consuming more goods and services. It's going to put more pressure on, people traveling, using petrol, consuming, more, well, as I said, more goods and services. So that's going to drive macroeconomic activity. So that'll be a good thing. Especially for us, because we're positioned for that trade. Anyway, I think, again, that's about enough for today. We're on the 15, almost 60-minute mark. So please have a wonderful weekend. If you do have any questions about anything, absolutely sing out. Let me know if you'd like to schedule a Zoom call, or actually, you can just go in and book yourself on a Zoom call and chat with me for 15 or 30 minutes about your account. So happy to do that. Again, have a great weekend, and I'll talk to you soon.